Now, ladies and gentlemen, in the next 10 minutes, I'll be explaining to you the risks that are associated with investment in money market funds. And here with me, you can see I have 7 risks that are associated with money market funds. And ladies and gentlemen, without wasting time, I would like to go to my point number 1, that is credit risk. All right, you can see here, credit risk. What do I mean by credit risk and how does it affect the money market fund? Now, you realize that the fund managers or the people that you trust with your money, where you've put your money, the fund manager is going to invest your money somewhere so that they can get a return that is going to transfer it to you. Now, one of the areas that fund managers are going to invest are commercial papers, all right? And what do I mean? And how do they invest in commercial papers? Now, an organization or an entity needs money to fund its short-term obligations or to improve its liquidity. Those organizations are going to sell what we call commercial papers. Now, investors or the fund managers are going to subscribe to those commercial papers, or they are going to invest in those commercial papers. That means they are going to lend money or give money to the entities, and then they buy that commercial paper. If the entity that has been given the funds it's not able to pay the funds on time or at agreed period, then there will be a credit risk to the fund manager where the entities has not met the agreement of paying back the money on the sale agreement of commercial papers. And that is where the credit risk comes in, because the fund manager has lent some money out and then expect the money to be paid at a particular date, but the entity or the borrower or the issuer, we call them the issuer of the issue of the commercial papers, have not been able to meet the agreement of paying back the money. Then that's where the credit risk comes in. All right. Now, the second risk, we are talking about the interest rate risk. This is where the interest rates of the money market funds fluctuates from time to time. For example, it goes up and down from time to time. Of course, it's affected by so many factors that happens in the market. It can be affected by the government. It can be affected by the inflation. It can be affected by regulations and so on and so on. So interest rate risk is where the interest of money market fund actually goes down, doesn't go up. When it goes up, then it's a win to the investor. But when it goes down, it is a risk. The third risk is inflation rate risk, the inflation rate. And as at now, we are talking, it's about 3.6% to 3.8%. You realize now the inflation rate is 3.6 to 3.8%. Inflation is where the commodities and the prices of the commodities and the prices of goods are going to, the price of goods and services are going to go up. And when they go up, it means money loses value. Now, ladies and gentlemen, the worst case scenario is where the inflation rate goes up and at the same time, the interest rate goes down. The interest rate of money market fund or the returns, they go down. When they meet like that, it means when you invest in a money market fund, you're actually making nothing. It's as good as putting your money in a bank account, which is not giving you anything. So, ladies and gentlemen, assuming that the inflation rate goes to 10% and the money market fund is giving you a return of 10%, you realize there is nothing you are doing there. It's as well as putting your money in a bank account. But ladies and gentlemen, we just hope that nothing like that can happen. So we have the interest rate risk of money market fund and inflation rate, but this one affects a lot. It affects a lot because here we are saying that we are supposed to put our money in a fund, in an account that is going to beat the inflation rate. All right. The fourth risk, we are talking about the liquidity risk. And liquidity risk here, we are talking about the investor's ability to withdraw their money from the fund manager or the market fund that they have invested. You realize that the fund manager, if they are not able to provide the funds readily available when the investors want them, then there is a problem with liquidity in that particular organization. And just as we said that the money market funds are regulated by the Capital Markets Authority, and of course they have independent oversight, that's the custodian and the trustees, who are going to make sure that the money market funds invest their money in the right way and in the right investments. But in most cases, liquidity risk is not going to be so much in common, but I have seen a case scenario recently of Mali money market fund where there is a problem with liquidity risk, but at the same time, I've seen the Capital Markets Authority have come up and have assured the investors that their money are safe. So liquidity is where the investor or the fund manager is not able to meet the needs of the investors. Remember, an investor is someone who is going to put money in a money market fund, and in any time they are going to need that money for other opportunities that are open to them. So ladies and gentlemen, we have liquidity risk. The other risk is management risk. This is where the investor or the fund manager is not going to make good investment decisions. And when they take a very high risk, they are likely to lose the money to other people because of not measuring the risk. And that's where the aspect of regulation by the Capital Markets Authority comes in to make sure that the fund managers have invested the money in the right way, just to make sure that they have preserved the capital of investors. So management risk, of course, there is mismanagement of funds by the fund managers, but remember there is an independent oversight that is also authorized by the Capital Markets Authority. Then number 6, ladies and gentlemen, we are talking about regulatory risk. This is the aspect of the government. It is the changes in the government regulations. For example, tax regulations, reporting regulations. We have other regulations that may be posed by the government. For example, investigations and so on when there is detected some fraud or something. So government policies and anything that may come along might affect the money market funds in a negative way or in a positive way. So there is regulatory risk by the government. And the last one, number 7, ladies and gentlemen, we are talking about money market. We are talking about market risk, and these ones will be determined by the market conditions. For example, inflation. We are going to talk about anything to do with the market that is going to affect the market. For example, you can talk about prices of goods and services, commodities goes up, and so on and so on. Just anything to do with the market conditions, how the market is behaving. For example, in recession, in the economic recession, financial crisis, and so on and so on. These are the 7 risks that you can think about that are going to affect money market funds, and hope you are going to oversee the risks. Now ask yourself, is money market fund that you are investing in, which of the risks are they associated with? Which of these 7 risks are they associated with? Ask yourself that question. Ladies and gentlemen, this is John Mweri, professional accountant with ex-FinOp Accountancy and Consultancy. And if you have any question, just go to my bio and take that number, and I'm just one call away. Thank you so much. We'll meet in our next video.